number 9 or 10, I believe, at 9. Thanks again to Keith Bowen. This is actually his second appearance on the Cresco webinar. So first for you, Keith, we owe you a bottle of wine for your second appearance there, so thank you. The topic today is really the day-ahead market, reserve markets, balancing markets, multi-market model. There's sort of lots of ideas and planning in that. Keith was also going to touch on a little bit of the standard offer, but I understand that there is a webinar this afternoon, standard offer / auction. Keith, maybe you just want to touch on that, and then I will just set the scene in terms of how we see the multi-market model fit within the program. Thank you.
Thanks, Robert. Yeah, so just in terms of the standard offer, hi everyone. The standard offer is really just a short-term mechanism that we have sort of designed to deal with the idea of trying to get additional energy out of existing capacity. Specifically, we know that there are people who are developing or have already developed renewable supply to mines, to other large off-takers, but there's always this issue where there's throttling of the production because the mine can't take it all, and we don't have a mechanism to buy that energy on the market. So the idea is the standard offer is there to try and accommodate for that excess, for Eskom to buy that excess under a standard offer price. We've got one, which is the static offer price, which is really a year ahead predetermined sort of price, and another, which is a more dynamic price where we determine based on our avoided cost of generation on the day, or at least day ahead. And then the other is what we're calling the emergency generation program. And there the idea is for people who have specifically flexible generation, for us to be able to buy that on a sort of daily basis in what we call our internal market. And when we talk about the market structures now, you'll see when I talk about the day ahead market, we have already introduced a lot of that internally within Eskom. And the idea is that we're allowing for people to actually effectively participate in that market from external participation. And that's really what we're looking at in terms of the two products, but we can go into a bit more detail on that, or also talk about it this afternoon with the CIPO conference. Thanks.
Cool. Thanks, Keith. So this afternoon is not an auction, so I shouldn't bring my electron.
No.
It's an info. Brilliant. Thank you very much. So I think from there, I wanted to sort of just set the scene for today. And really, this is linked to the whole power sector decarbonisation. And many of the people on the call have seen this pretty graphic that we use over and over, and it kind of link it back. So for many of our clients, we're really focusing on achieving that 20 to 40% renewable penetration target, depending on your load, geography, type of technology and that. We're then looking at the 30 to 60% target on the other side, and that will include sort of the use of large-scale battery storage, lithium, ion, eventually other ones, and all our other webinars have touched on various the opportunities there. But really, the big link for me today to what Keith's going to talk about is sort of what do we do with this excess energy? Is there an opportunity for merchant plants? And where does this energy go, and linking into the trading platform? So this is an example project, and I've taken out all the numbers in that, but this could be a 10 megawatt load, 100 megawatt load, or 1,000 megawatt load. I think the answers are pretty similar if you have a base load sort of demand structure. And what I'm trying to say here is we've run various scenarios. So we've run sort of 3 scenarios, trying to offset and achieve large renewable penetration. So sort of a 30% solar, a 70% wind in the top right. This obviously does assume that in a 10 megawatt load, you will actually get 7 megawatts of wind. So that's not always possible. We don't see standalone wind turbines, but for the purpose of the analysis, let's go that these are available. And you can see here, the wind and the PV actually achieve quite a nice offset. Scenario 2 on the bottom left is one that we believe is a lot more likely because there's a lot less wind. REAP 6, I think, is going to eat up a lot of the good wind projects. The quality of the wind projects we see decreasing over time, as well as the availability, and new wind projects take 5 or 6 years to develop. So we're more likely to see more solar being procured or available and 20% wind. And with this matrix, you can see there's this huge jump in the middle of the day. And the question is, what do we do with the solar in the middle of the day if you're a buyer? You're having to contract it as part of your procurement strategy to achieve renewable penetration levels. On the hourly reconciliation, you're losing the money. From a renewable penetration point of view, you're not getting the full benefit on the scorecards and things like that. So for us, one of the answers is call it the 60% solar, 20% wind, and 20% solar and BESS opportunity. Now, in this scenario here, it actually takes up most of the excess energy. There's still a little bit of energy demand, sort of 5 to 10% there. And that for me is really what the opportunity of the multi-market model, the trading market is. And that's where I see our clients being interested in what Keith has to say. So this excess energy for me at the moment is really an Excel problem. In reality, it's going to become a technical problem. It's also a commercial problem. So there's three ways to get rid of the excess energy, I guess, financially. One is to obviously put it into batteries. Secondly is to sell it to other buyers. And third is perhaps make use of a trading multi-market model. So this is where it links into a lot of the energy strategy work. And with that, I will hand over to Keith to take over and run from there. Maybe Keith, just for the benefit of everyone, maybe I should have actually start with your position and role within Eskom.
Thank you. Thanks, Robert. Yeah, so Keith Bone, I'm with Eskom Transmission and in what we now call the market operator. Historically, it used to be the buyer's office, as most people would know from the perspective of the renewable IPP program, but now we've kind of separated out into what we call the central purchasing agency, which is really still the buyer, and then the market operators for the development of the future trading platforms. So I'm going to share then my screen. So before I start going to the detail, just a little bit of the sort of theory when we talk about the development of the markets. One of the important things is that historically, often when we look at particularly energy's really been a whole lot of different services or products are kind of bundled into one item. So when a consumer buys energy from the grid, often there's various components of that energy which just really get bundled together into one product. But now, as we get into the future sort of market environment, and also to a large extent because of the penetration of renewables, we're finding that you get some differentiation taking place between these different products. So this kind of the petal diagram that we use quite often is just to show that this is already part of the same overarching kind of principle, but energy market, but there are different products and services within that market, and often we can develop different market platforms to accommodate that. So firstly, we have the capacity market, where capacity it becomes quite an important aspect to ensure that on any particular point in time, when someone consumes or there's a demand in the market, that there is the ability to supply that regardless of where the production is and where it's taking place. So capacity in itself becomes a differentiated product. We talk about the day-ahead energy markets. That's the stuff that we can predict and plan for in the day-ahead market and schedule accordingly. And there's trade that takes place around that day-ahead energy. Similarly, the day-ahead reserve market is also where the system operator can set reserve requirements, but we kind of co-optimize between what's happening on an energy side and what's happening on the reserve side to ensure that there's sufficient and hopefully optimal energy reserves available for the system operator to call upon in real time. So it is a subset of ancillary services, but dealing very specifically in allocating capacity for utilization in real time when there's a need on the market. The balancing market or the balancing mechanism is really what our true up between what happens in real time versus what was expected to happen on the day ahead. And that really is also, it's about the flexibility and energy available in real time as opposed to something that's scheduled day ahead. And there's a different sort of value attached to that, to what it was scheduled day ahead. Then under ancillary services, we also talk about the other network support services, be it reactive power, black start capability, islanding, constraint generation, different things that are required to support the network, which aren't necessarily energy-based, although they are energy-related. And that in itself has quite a huge value that generally tends to be understated, specifically in a utility environment. Historically, well, other services generally are things that we kind of do and take for granted now. But as the market develops, we will see that these start growing. And it could be, for example, forecasting demand, forecasting availability for supply, particularly renewable capabilities. That becomes quite an important service. The balancing itself, the ability to balance amongst different consumers. So a retailer might offer a balancing service to a whole lot of customers because it's balancing across a portfolio as opposed to a particular customer being exposed for their own imbalances in the market. So those kind of services we'll see growing quite a lot as these markets unfold. When we talk about the actual market structures or the platforms that we're talking about, it's quite a busy slide, but here we're talking about the transmission system operator or the future TSO. We have obviously the system operator and the network operator being the key components for the traditional transmission space and making sure, particularly the system operator, that we're matching supply and demand on a real-time basis. But some of the new items we're dealing with is the central purchasing agency, which from our perspective is still required specifically for legacy contracts. So we're talking about the Section 34 IPPs that are currently in place and quite possibly bid window 6, and there are others in the works, that even as the market opens up, you have to keep those contracts going. We don't suddenly break those contracts and everyone now get exposed to the market. So those legacy contracts continue. So the central purchasing agency carries on as the buyer of those contracts, and the energy delivered under those contracts are then sold into the market. So the CPA is that sort of interface to keep the legacy components going, but the market now is still active with that energy being supplied by the CPA. When we talk about capacity, it's also quite possible, depending on how we roll out a capacity market or a capacity mechanisms, that the central purchasing agency retain some authority or requirement, particularly in terms of the Electricity Regulation Act into the future, that the central purchasing agency has to ensure that there's sufficient capacity online at any particular point in time to meet demand. So there's almost a supply of last resort kind of mechanism still in place to ensure that the capacity is there even as the market develops. And that might mean that the CPA is paying generators, whether it be Eskom's existing power stations or new IPPs, some sort of capacity charge or service, pay for that service, and then recover it through a capacity charge downstream. So there's quite a bit of a role still for the CPA, even as the market unfolds. But the market operator itself is really just provides platforms. It's not a trader. It's just providing the mechanisms to allow buyers and sellers to meet in the market. Specifically, we talk about the day-ahead energy market and the day-ahead reserve market, and I'll spend some time kind of going into the detail of those. And it's really a trading platform where generators offer available capacity or energy that they can supply at a specific price, and consumers and retailers would bid in to say that they want to buy either through a forecast or also even demand response kind of prices to say how much they want to buy and at what price. And the market operator's responsibility is to match those two and to clear the market and provide a price signal to all participants. We also then have the concept of the intraday energy market to deal with what happens between the sort of day ahead and the real time. Often the day ahead, the results might be out, and our expectation, let's say it's 2 p.m., sort of the day ahead of operation, and anything can happen between that time and the actual hour of operation. And it means that whether generators or consumers may need to get themselves out of their position because whatever they've committed to produce or consume, something has changed and they need to get themselves back into balance. And that gives them the opportunity to do that and trade themselves before the balancing mechanism kicks in, which is more of a real-time true-up. And here it's because the system operator is instructing people to get the system back into balance. So if there is an imbalance, the system operator will call on whatever resources it has from a dispatch perspective, and that might end up being more expensive depending on how much of the imbalances. And the intraday just gives people the chance to actually hedge themselves or get themselves back into balance before the system operator does it on their behalf. So those platforms are effectively providing the mechanism for people to trade with one another. These are all physical platforms. They're dealing with the physical delivery and production and consumption by the participants. Similarly, and let me just move that out the way, we also allow for physical bilaterals. And this is what we kind of traditional wheeling contracts, that a generator can contract directly with a customer on a physical over-the-counter kind of trade. They've gone into a long-term contract and they've gone into the physical delivery to say the generator must produce that energy and the consumer must take that energy at any particular point in time. And there's obviously has to be some sort of declaration to the market operator day ahead to say what the position is for each generator or consumer who's in that trade. And the main reason for that is obviously from a system ops perspective and also the market operator knowing what trades are taking place and what the production and consumption is going to look like. And then when it doesn't happen, and if there's imbalances, then everyone has to still be exposed to the balancing mechanism to get the system back into balance. There is the one that I haven't indicated here is an option of a financial bilateral. So instead of a physical bilateral, which requires physical delivery, the financial is just really a price hedge mechanism so that the physical trade still takes place in the day ahead and in the intraday, but the hedging mechanism is purely as a financial transaction to kind of deal with the price differences between counterparties. And that will become quite an important aspect of the whole market, because when people, particularly if you want to go into long-term contracts to get bankability for a new project, the physical component can happen through the market, but your financial hedges potentially give you that bankability with a bank to kind of get the financing for new projects. If I go into sort of the detail around the day ahead specifically,
sorry, can I jump back? And I've got quite a few questions. So
yeah, sure.
First question is a typical buyer. So if you have an on-site facility, one load, one generator, it's pretty easy. There's the metering and you obviously get some forecasting. If you're like some of our clients, you might have up to 20 sites, 10, 20 generators over time. Firstly, we're seeing that they probably have to have an energy company themselves capacitated to be able to forecast their own loads there. So a little bit on what you think they should be doing. So that's the one question. Linked to that capacitation is obviously IT and software. Now let's leave the software required actually for the market operator, but in terms of software required for the sort of the energy code type structure on the buyer, what is out there? What are you seeing? We're not seeing any one that really helps everyone. There's bits and pieces that have to be sort of cobbled together. So those are my first two questions. Thank you.
Yeah. So specifically, I mean, if you think about it, when we talk about a retailer, it can also just be a trader. So a trader can have energy that they've purchased and going in with generation as well as consumption, and they're just looking for the differential between maybe they're producing more on one day than what they're consuming, and they're offering that into the market, and the other way around. There's also the possibility for a retailer to have no exposure to generation and to buy everything on the market with obviously CFDs, contracts for differences, or financial hedges around that. The biggest issue is going to be around forecasting. It's that ability to know what it is that your customers are going to do, and if your generation is renewable, then obviously what is the expected production in terms of PV output, wind, etc., and how are you matching those? So the market will provide some of those signals in terms of the pricing, particularly on the financial side, but you may want to also have backup in case the market prices now get extreme, because you might have to rely on gas turbines or someone to provide that backup, and the market prices would move around that. But I think the forecasting is the biggest, the most important aspect of the systems that you would need, and then being able to match those. One of the things that would be a thing for a trader and potentially even a retailer is having almost real-time metering data, being able to pick up what is happening with my customers, what is happening to my position, and how much am I exposed as we get closer and closer to real time. Because that's where the balancing is going to kick in, and having a good understanding of that. So yes, the ability to draw all that data together is really one of the biggest kind of, maybe to say, the complications, but it's also a big opportunity for people who can provide those sort of services to be able to pull that metering data together so you can see the position. What we're trying to do with the intraday and specifically is that it doesn't require a 24-hour operation. You know, potentially like in the Southern African Power Pool and other mechanisms, it's a bulletin board where people can see that their trades are available and you can buy and offer in that market on an ongoing basis. What we're trying to actually do is turn that into an auction so that if when you see you're in trouble, you can make a bid or an offer, and then every 6 hours the market clears, and then you kind of get a new position based on that, rather than having a 24-hour operation and you having to look for the next best trade. The intraday just clears itself every 6 hours to allow for people to kind of not have to have that 24-hour operation. But a lot of those sort of systems are still going to be there. The market operator obviously has to have systems available to allow for those trades happening all the time. But traders, retailers would also have to have their ability to see what is my exposure and what is my position currently. Hope, Robert, that answers
no,
the
I think
question.
but if I put that in a worked example, so we have a buyer who forecasts for 100 megawatt hours tomorrow load, you know, and I guess an unplanned maintenance event on the load side is less of a concern because there'll be excess energy available. You know, it's more demand that's the problem. And then he has forecasted, and his PV project says he'll give a 25 megawatt hours, and the wind project he's procured will also give us 25 megawatt hours. So that's over the day. I'm conscious this could be in the hour too. So there's two extremes in terms of the detail. And at 12 o'clock during the day, they find out that the wind is not blowing in the Eastern Cape, but the PV project is producing. And that's obviously the type of technology you're dealing with. So they now are going to have a shortfall. So, you know, I guess they can either wait for you to charge them for balancing power at that point in time, or they can try and mitigate that financial impact by actually going into the intraday market to buy balancing power that is available at 12 o'clock. And I guess at 12 o'clock, in a few years' time, there'll probably be a lot of PV available. So that probably won't be a big thing. But if you use my example and you look at 6 o'clock in the evening, where you were hoping to get wind, then that cost of that power could be prohibitive because it could be OCGTs. Is that right?
Yeah, that's entirely possible. Yes. Yeah. You know, again, a lot depends on technology and stuff, because it could well be there's a lot of balance battery energy available, which, you know, as a marginal cost isn't as hectic as an OCGT. But yes, there's always that risk that if you were out, and let's say your forecast is out and then everyone else's forecast was also out because everyone expected a cold front that didn't hit and the wind is now a lot lower than what was expected, there would be a huge imbalance on the system and you're as exposed as a lot of other developers, traders, and you would then have to all be buying this extra power, and that could lead to, you know, going to OCGT kind of rates. So that's specifically the kind of thing where getting the forecast right is the most important, but you have those hourly prices to kind of give you the indication of what the value of being wrong, or the penalty involved in being wrong. Yeah.
And so when it's a 24-hour, when we talk about day ahead forecast, it's actually every hour in the next 24 hours. That's what we're looking at, really. Yeah, it's not absolutely 100 megawatt hours over 24. It's, you know, 4 times 4, 4 plus 4 plus 4 plus 4, simplistically, you know? Yeah. If that added up to 100. Yeah.
Yeah. At the moment, we're talking about hourly, but, you know, in other markets, they go down to, you know, half hourly, 15 minutes, and even in Australia, 5 minutes. Your interval is an option, is a choice that we make as a market. But, you know, for simplicity's sake, we're saying let's stick to hourly for now. But over time, you might want to get better, go for smaller intervals, and which means that your forecast error might be less. But it does mean that you're more exposed because now the actual hour, second by second balance is actually more important than just an hourly average.
Cool, thank you. And the last one, I've used your slide previously, so I'm giving you royalties in due course. But just people have asked about the legacy buyer for the Section 34. I mean, can you just quickly touch on that just for consistency? Thank you.
Okay, so the idea is that, as I mentioned, that the Central Purchasing Agency will continue to buy the energy from the existing IPP contracts and whatever's signed before the market is exposed or is opened. And it might even be that there might well be that, in the early days of the market, we would still have to go and do long-term contracts to provide that certainty for, new developers, because it's all of this is a transition to get to the full competitive market. And that means that there could be times, and probably will be times, particularly with the existing Section 34 IPPs, where the cost that we're buying at from the IPPs is much higher than what the market is willing to pay. So right now, our average for the renewable IPP programs are around just over R2 a kilowatt hour in today's money, whereas the market price might be 80 cents or 90 cents or whatever, depending on the conditions. The Central Purchasing Agency has that shortfall. And that what we are proposing as part of our sort of kind of idea of the multi-market model is that legacy charge should still be applicable to all the balanced responsible parties, to everybody in the market, because it's a cost of government decisions over the last 10 years, and that legacy needs to still be recovered even as people start exercising choice. So their Central Purchasing Agency would still recover through some mechanism, and we'll talk about that a little bit later in terms of the wholesale tariff, that there are components like capacity and legacy, which would still be charged at the balance responsible or cost side or at the transmission network. Those kind of components still have to be resolved. But the idea is that there's still some contribution to those factors. Ideally, it would be something that the fiscus picks up, because it's a policy decision, and it should be something that the state has to cover for. But I think with the reality of where the state's finances are now, there's not a lot of a chance that will be covered there, and that it would be, it's almost like a tax on all consumers in order to deal with that shortfall. I hope that kind of answers that.
It does, and I have two questions, and if I can, because I think this is sort of the crux of coming from the audience. So the question is from Sam: is the intention for the ancillary services market to be open to private entities, so IPPs or end users? My understanding is yes.
Yes. Yeah. So and here, sorry, if I can just, we've got to break up the ancillary services market into the various components. So specifically reserve market, so it's the day ahead kind of reserves, instantaneous regulating, 10-minute, those kind of reserves would be procured in the market, and all the participants, anyone who's flexible and can offer the service, and the system operator has certified them to provide that service, they would bid in and then get chosen based on the optimization that takes place on the day ahead. So as I think I kind of mentioned, the day ahead energy and day ahead reserves, we do a co-optimization kind of process rather than have them being completely discrete and someone decides how much goes into reserves and how much goes into energy. We allow for the scheduling tool to give us an optimal solution, and that allocates then the reserves to either day ahead reserves or day ahead energy, and to kind of balance the system out. The other ancillary services, so you might have, as I said, the system restoration kind of stuff, black start islanding, those capabilities. It might be something it's kind of done on a regular auction. It might be every 5 years. Those are sort of some of the details that we kind of have to work out. But the idea is you would want private generators as well as the traditional Eskom generators offering that capability. Constrained generation is a little bit more difficult because a lot depends on the network requirements, that you might have certain generators in specific locations who might be used for what we call constrained generation, where we pick them up to provide more energy because there's a network condition, and then others would have to be backed off because the system still has to be in balance. And that would be a cost to the system operator or the network owner to make sure that they alleviate those constraints. So yeah, ancillary services is broken up into different components, but the idea is that it should be a competitive market for people to provide those services.
Cool, thank you. There's another question, but I understand you will be answering it later. Is a bit, when is all this planned to go live? But I believe you'll be touching on that later. Thank you.
Yeah. Okay.
Thanks, Keith. Please
Great.
continue. Thanks.
So, I mean, conscious of time, so I'm just going to try and go through this relatively quickly, and we can, if there's more explanation required at the end, we can talk about this. But the idea, for example, from a generator perspective, the idea is that every day generators are able to offer at a generator unit level or on an aggregated level energy to the system, and they provide what we call an incremental price curve. And the idea is here that it's a price over the range generation capability. So this is obviously very much a thermal-based generation plant where there's a min gen and a max gen and then an incremental cost of production over that period. And that is what's provided to the system. And it's quite important that it's the incremental cost of production, and it's not just a thumbsuck of what, the price that you'd like to get to maximize, because the whole idea is that when we do these market clearing, is that the optimal market clearing is if everyone's bidding their short-run marginal cost, then the market is getting the optimal solution. And we'll talk about what that means in terms of market clearing shortly. The price curve at this stage, the way we've designed it, just for simplicity's sake, is that it's a price curve that applies for the whole day. The hourly availability would determine whether a generator can produce at full load or reduced load, depending on conditions at the plant. There's also the option of being flexible or inflexible. The idea is that a flexible generator is one that allows the system to determine what the production will be based on the cost. An inflexible generator is one that says, look, I don't care what the price is, this volume is what I have to produce. And here, it kind of makes sense for a renewable plant, even for a nuclear plant and others, that they're not really price responsive. They can't move around depending on price. This is what I expect to be able to produce. Just give me the best price for my volume. So a flexible generator sets the price and lets the market decide the volume. An inflexible generator sets the volume and lets the market determine the price. And that's really the difference between the two, and we allow for both. And obviously, the flexible generators are the ones setting the price, and then the inflexible generators are the ones getting the benefit of that price, because obviously it would depend on, if you have too much inflexible generation, the price would be low. If you have a lot of flexible generation, it's quite likely in the opposite direction. But we also take into consideration the technical parameters. So it's like the minimum up and down times, startup rates, ramping rates, all that kind of information that a scheduling tool would want to ensure that the outcome is technically feasible. It's quite an important difference. In Europe, they don't do any of that kind of technical parameters. A lot of the stuff is just pure market, supply and demand, and the technical issues are to the power station to deal with after the fact. In America, it's a lot more sort of centrally dispatched. And so we kind of tend to be on the American side, particularly through this transition. Our system operator wants to make sure that whatever we produce, they can know that technically it's feasible and will be able to be met by the generators in real time.
Keith, quick question. You talk about the word flexible and inflexible generation.
Yeah.
Would we be paraphrasing that for dispatchable and non-dispatchable renewables or not? Or are you thinking more diesel engines that dispatch quickly versus coal-fired power stations that take a while to ramp up? Yeah.
So you've kind of got to be careful that even some sort of dispatchable generators are not particularly flexible. So it's kind of like the flexibility is about the fact that the scheduling tool is able to make the decision. So yeah, in that way, it's dispatchable, that the schedule is determines the volume, as opposed to the generator fixing the volume beforehand. But so for us, it's the flexibility is the important part, is that for the system operator has the right to dispatch. So to some extent, they are interchangeable, but we also have to be aware that, some dispatchable plant is not particularly flexible. But yes, I think on this basis, it is more about the dispatchability.
Thank you.
Yeah. What's quite important here is that also the idea that demand is not just a forecast. So, historically, when we looked at this and internally within Eskom, so the important thing is that we're running some of these markets right now within Eskom. So our power stations every day bid in availability and their costs, and we schedule according to a forecast. So the system operator provides a forecast, but it's set. It's price inelastic. Whatever, we forecast 29,000 megawatts for this specific hour, we will schedule up to 29,000 megawatts. But there's also quite an important aspect of this, is that very soon or in the future, we would start getting retailers saying, you know what, I'm not just there for, I'll be a price taker. I can actually also influence price. That if the price is going above a certain level, I've actually got some customers who are willing to reduce their consumption because the price is too high for them. And so you start getting a price responsive bid. It's quite an important aspect in terms of that price setting, because it means that in the absence of price responsive bids, prices will be higher and the volume would be higher The moment you start putting in price responsive bids, as this graph is kind of trying to suggest, is that you might find that your volume decreases because some of your volume demand is being withdrawn, and that your prices then would drop. And it could well be quite a big drop. Like if you think your marginal generator is an OCGT, a diesel gen, and now you've got a customer saying, well, I'm not going to pay R8 a kilowatt hour. I'd rather just reduce my consumption. Then you could actually preempt that, and then your price is maybe, the marginal coal plant at 80 cents. And that's a big difference, just with a couple of, 100 megawatts or maybe even 1,000 megawatt of customers withdrawing demand. So that price responsive bid becomes an important aspect into the future in terms of price setting as well. And it's where supply and demand meet is where the price will be set for all.
So we're saying, I mean, previously we had demand response instantaneous, and that demand response, and I know we've now moved in some cases to NPAs where it's sort of contracted. Are we saying now that demand response movements by loads could be remunerated obviously at the price point of the market, as opposed to what Eskom was sort of offering under the simple standard offer, which I understand was previously considered?
Yes, and the important thing here, and when we do demand response now, is that we effectively pay for people to reduce their demand, and it's because to go into the whole economics of it, we're charging an average rate for consumers, but the marginal cost, it's actually better to get those consumers to withdraw, so we would pay them to withdraw. If people are more exposed to the marginal cost, so the marginal cost is the peakers, then customers would make that decision on their own. So rather than getting paid to reduce, they know that I'm trying to avoid the R8 a kilowatt hour. I will reduce on my own bat, and I end up paying a lower price for the energy. So it's quite a big shift from the retailer giving an average price and then compensating people to withdraw. What could happen is that you might still have average, but there would be a marginal component in that, so that you can see that for a consumer, it's better for me to withdraw. And that's kind of, I think, where we're going with price responsiveness, is to give people the option. And you might compensate them for it, but the retailer as a whole benefits from the lower price. And in fact, all the consumers benefit from the lower price. So some would make the sacrifice, and maybe you'd compensate them for it, but then all consumers get the lower price because now the marginal cost it's the lower marginal cost for everyone.
Cool, thank you.
Yeah, cool. And so one of the important things, and this is a big debate that's happening in Europe at the moment, the concept of the market clearing price is that you have the supply curve and you've got a whole lot of cheap generators down here and going up to the more expensive, and let's just say it's the OCGTs at the top end of the scale, and that you might have demand response where there's a kind of a lot of demand response in the market. Where the two meet, that market clearing price, it's where everybody pays that price and everyone gets paid that price. So if we think about, let's pick on Matimba as one of our cheaper coal generators, its price may well be 25 cents a kilowatt hour, whatever, but if the price is being set at 90, they get paid 90. And one of the big problems in Europe, and people are complaining about it bitterly, is that a wind farm whose marginal cost is zero will get paid the marginal cost of the most expensive generator, which is going to be a gas turbine burning LNG imported gas. And there's a huge outcry about it because it seems unfair. But the reality is that almost every market that we know of, it's done on a marginal clearing kind of basis. I mean, if you think about a wheat producer, a farmer, the price that they get for their wheat or whatever product is often totally unrelated to their costs. If the market is willing to pay them X, then they would, make a big profit if the price is right. If they get paid below their cost, they lose out that year and probably would plant less the following year as a consequence. That clearing price is, just because it's electricity, people get really worked up about it because they hate to see someone doing well in that market. The opposite is also true, is that for the last 5 years, wholesale market prices have been so low because there's been this flooding of cheap marginal cost, zero kind of renewable plant. And then the more expensive generators are actually just not running or not making money in the market. And it's now swung in the other direction. Then suddenly everyone's calling for the market mechanism to be undone. It's just one of the things that you can always look at a two-tier kind of framework that maybe sort of marginal expensive generators are on a different tier to the others. But the reality is that a clearing price is just really how a lot of trading takes place. And electricity is not that different in this environment. And specifically, if we're doing daily auctions, if we do pay as bid, instead of paying, let's say, Matimba the clearing price, and we only pay them what they bid, and they see that other people are getting the higher price, they're going to start ramping up their costs that they declare, their price into the market in order to maximize their revenue. And then effectively your scheduling now becomes dysfunctional and unoptimal, because now you don't know which is the cheapest generator anymore, because they're all just bidding whatever price they want to make in the market. So it's quite important that the clearing price helps us determine the optimal outcome for the market, rather than trying to do pay as bid. Okay. Yeah, so when we now talk about the balancing, and I realize I'm just also conscious of time, that when we have a day ahead, after the end of the day ahead market and the physical bilaterals, the idea is that there are various positions. So there might be the physical positions, which are declared from all the generators with their physical bilaterals, with the large power users on the right, or the retailers. And then also the day ahead clears out a lot of the other positions. So you find some generators have got a dispatch scheduled for a particular hour. Your consumers are set up in terms of what they have to produce. In real time, or on the way to real time in terms of intraday, you may find a generator trips on one of the power stations. A power station can back itself up. So if one trips, then maybe the one that wasn't scheduled can pick up to be able to balance, and the net effect is zero. But it's also possible that, if a retailer now is going to consume less, they can offer that for someone who's going to consume more, that they can balance between them at a price, obviously. And then a generator can back up a retailer that suddenly finds that they actually have higher consumption than what they thought they were going to do. And that's also the intraday helps clear that out through regular auctions. In balancing, what we would do is that we take out the result of the day ahead market. And it's an important idea of what we've kind of proposed from the perspective of Eskom in terms of how we see the market, is that your bids and offers flow kind of almost seamlessly from the day ahead into the intraday, into the balancing, so that your balancing stack, or the merit order that the system operator sees, is what was offered into the day ahead market. There's no opportunity for arbitrage or gaming to try and suddenly offer more at a cheaper price or whatever. Whatever you've bid into the day ahead effectively flows through to the balancing as because you're a flexible generator or demand response. The system operator then sees that as the next available for it to call on. So we then create what kind of a balancing stack or a merit order of the generators or demand response on sort of in an upward direction, and also who can back down in a downward direction if there's too much on the system and you have to back off some of the generators. That means that when you now have imbalances, and you kind of see in real time or after the fact, so all of this is done after the fact, we go and measure what was produced or consumed versus what the positions were, and then we can go and do a true up as to who caused the imbalance and who responded to system operator instructions. So some people would have done, a generator would have tripped, or the forecast was wrong, and then others would have been instructed by the system operator to make up that difference. So what we do is we then go and calculate, and again, this is a proposal from our side. We look at kind of the perfect dispatch. If the system operator had all the time in the world, which generators would it have called up in perfect order, so that you use up one increment or one tranche before the next, and we calculate a price based on this perfect dispatch. In reality, the system operator is calling up all sorts of generators all at the same time, because it can't wait for one to finish ramping up before calling the other. If there's a problem, it might instruct 4 or 5 generators to pick up at any particular point in time. But what we do is we kind of then sort of average out that cost, and there might be an imbalance between what we charge as an imbalance charge to those that were out of balance and what the system operators actually paid for. But over time, we kind of manage that difference, and recover it as part of the ancillary services cost. So yeah, we calculate a price for the upward direction, and that's the other thing that we're proposing. There are 2 prices in each hour, those that cause an imbalance in one direction and those that cause the imbalance in the other direction, and you charge each of them. And the idea is that that penalty, and again, the idea is that it's not meant to be extreme, but it's meant to incentivize people to keep themselves in balance, so that even if you tend to accidentally lean in the right direction, that the whole system's sort of going up, but you happen to take some out of the system, you then might still be charged even though you were in the right direction. And it's just really to ensure that the participants are providing the best information they can day ahead and not accidentally benefiting from being out of balance. The system operator then, as I said, would instruct.
A few questions quickly.
Yeah.
So I know we're running, but hopefully people are finding the questions at least valuable. So I know SAP has introduced a balancing market. Is this how they also calculate the balancing price? I know it's too early to get a real feel for the market, but is it a similar methodology?
No, in SAP, it's much more sort of almost like a bulletin board of the intraday, where it's done by system operators and control area operators between them, trying to keep the system in balance. So this after the fact kind of true up, as far as I understand it in SAP, is not quite the way in which they do it. We're looking at it from the perspective of a system operator that's balancing for everyone, and then trying to see who has to pay for what. So the SAP one's quite different from my understanding of it.
Okay, cool. And the next question is, you talked about this is Eskom's proposal.
Yeah.
I assume this has to go through a normal NERSA process, but once the methodology is approved, the market is created, then it is transact as under the rules, and it can't be changed. Yeah.
So the idea is, again, in the electricity regulation amendment bill that's being passed, is that there would be a market code. So obviously in the Act, you don't really talk about the detail of the market, but the idea is that it allows for the regulator or the market operator to establish a code, and that code would then provide for all these mechanisms, and theoretically the regulator approves the code, again, which then sets the rules for the market. So yes, all of this is just kind of our thinking. When the code is now developed, it might end up being marginally different, or there might be big differences, because that's, again, it's a discussion point as to the way to do it. So even on the imbalance prices, we might decide that we want a single price for each hour, whether above or below, but our proposal is to keep it as 2. But yet they would definitely be something that comes out of the discussion for the market code.
And then at the moment, this is sort of linked to wheeling. The reconciliations are done hourly, but reconciled from a financial point of view on a time of use basis.
Yes.
So you can cover any shortfalls or imbalances, losing on the Thursday, catching up on the Friday, and you see it at the end of the month. But I assume for this to actually work, those reconciliations will actually have to be hourly in the hour, or other timeline. So
Yeah, totally. I mean, when you've got a balancing mechanism in place, then it is hour by hour balancing. It's kind of, you said you were going to produce 100 megawatts, but you didn't, you produced 90, you have to be back in balance. But the idea is that then if you've got a wheeling contract, both parties are theoretically balance responsible. So it's the generator and the customer. If the customer, nothing happened to the customer, they said they were going to consume 100 and they still consumed 100, but the generator was out, then the balancing would apply to the generator. If both were out, then yeah, it applies to both. But the idea is that a customer also becomes balance responsible in the future, but they might do it via a retailer. So maybe, the municipality or Eskom distribution would actually do balancing on behalf of their customers, and they allow that in terms of their wheeling arrangement. Or if someone as a large power user says, you know what, I'm in the market, I will deal with balancing on my own, they would then have to be balance responsible as well.
And so what I can see is for renewables specifically, which is obviously where most of the generation initially is going to come from, is you might be willing to pay more where the generator is willing to stand by its generation profile, rather than because at the moment we have sort of capacity performance tests that say if the wind blows, the project will generate. Whereas now in my view, you're going to say, well, I'm relying on that generation, I'm paying balancing. You need to guarantee me your P90 forecast, and if it's a P50 forecast and it's above, then we share the. I mean, because at the moment that's not how a lot of these wheeling deals are being done, but this is going to drive that behavior, sure.
To some extent, but it's also about the forecast. So it's not about what you predicted a year in advance or at the time of developing. It's about what you said every day you were going to do. But obviously, for the consumer, they want to make sure that when they've gone into that contract in advance, that you can guarantee that price. Otherwise, they have to buy it on the market or from another generator. So yeah, but the most important thing is going to be from an imbalance perspective, it's the day ahead. What did I say I was going to do day ahead versus what I've actually done?
Cool. Thank you.
Okay. Cool. Then, as I said, the system operator would instruct multiple generators to operate at the same time. So we might have some that are out of balance. And that differential is really where it would probably be covered by an ancillary services and spread to all consumers rather than just focusing on penalizing those that are out of balance every hour. Just to talk a little bit about the transition in the last few minutes, is that when we talk about the transition, we also say, well, the central purchasing agency might, and this is again our proposal, go into vesting contracts with the existing generators, so those that are now going to be exposed to the market, and here we're talking about Eskom generation, and it might well be others that choose to be on the market, could get vesting contracts up front, and then Eskom distribution and any other distributor that might be willing to participate in the market also has a vesting contract. And what we mean by vesting contracts is really a hedging contract, which as the volumes, as we go through the transition, and again, we propose a 5-year transition, the volumes on those contracts reduce over time, so that you start with 100% hedge, the next year 80, the next 60, 40, 20, until they're fully exposed to the market. And then they start hedging with one another, so that the central purchasing agency is no longer the counterparty to everybody. It's kind of no longer in the market, except for the long-term Section 34 IPPs we talked about. And all the other energy volumes are now traded either day ahead physical or physical bilaterals, but also with long-term financial hedges between the participants. And that to us is quite a big, important thing about how we get from where we are now with those regulated prices to competitive prices over time in the next 5 years. And that's, again, kind of a concept of the transition. When we talked about
once again, quick questions. So just like financial products generally start on an over-the-counter small basis and then eventually move up to the main board, the JSE, do we see something like that happening in the first transitional phase? And then the market phase, do we potentially see the JSE or one of those exchanges build a new sort of network, or do you see this being its complete standalone link to Eskom?
Yeah, so I'm not sure about a new network. I mean,
so not a new network, sorry, a new trading platform. Sorry, not network.
Yeah.
Sorry, I used the
so
wrong
I'm thinking again, as the market operators, that we establish the platforms and we would be responsible specifically for balancing, but that the day ahead is effectively a competitive trading platform. It's not a mandatory platform for everyone to participate in. So again, if people choose to establish a second or even a third or a fourth exchange for day ahead energy, that's fine, as long as the outcome is declared to the market operator to ensure that the physical delivery takes place in real time. But the idea that the TSO, or the transmission system operator, establishes a platform for trade, day ahead, intraday, and balancing, but it doesn't mean that everybody has to go through that platform only on the balancing side of it. So yeah, it's quite possible that the JSE establishes that. Our thinking is that for the longer term forward contracting and futures, that might be done on a JSE kind of platform. At this stage, as the market operator, we're sort of more focusing on the physical side of things and less on the financial, but that might develop again over time.
Thank you.
Yeah, so just to then talk about the wholesale tariff, obviously, as we get into more and more into a competitive market, there are some elements of it which would be still sort of mandatory, that, as I said, capacity becomes an issue, ensuring that, and ideally we have a capacity market where everyone has to participate in the capacity market in the future, but it may well be for some transition, be a capacity charge that is coming from the CPA that everyone has to contribute to. And similarly, as we talked about, the legacy charge, and then also potentially a subsidy charge, because as the market develops, you're going to find that as customers are making choices, the distributors, particularly Eskom distributors and the municipalities, will have subsidies that they cross subsidies that they have in the current system, which now people are able to avoid by going and trading for themselves. And it creates a bit of a problem for the sustainability of those subsidies, that either that is a contribution through the electricity market or the fiscus picks up the difference. And again, that's something that, you know, we have to spend a lot of time looking at the subsidy framework. Is it going to be something that the fiscus has to contribute to, or something that we add on as just another one of those many tariff mechanisms that we just constantly come to customers for on a regular basis, but it's built into the wholesale tariff before you enter into the market. So yeah, this is part of that idea of restructuring, and so that energy is not just one bundle product as it has been historically. You start dealing with all the components around it, and that some of it is competitive and some not. Okay.
So just, I mean, the slide looks where it's going. I think the concern for many of the buyers here is the fact that the energy time of use as a proportion is reducing materially. Yeah. And obviously, as the cost of generation increases, it makes the savings or the benefits from a financial point of view a lot less. Now, we know that the retail tariff code is changing a lot of the structure, and we can understand that with a fair bit of detail, thanks to Shirley's Excel spreadsheets and stuff. But do you see the market further reducing the time of use component? Or is it just giving flexibility around it? Yeah,
it's just giving flexibility. So one of the important things is that, for example, ancillary services. Right now, ancillary services is ludicrously undervalued because it's, you know, it's within the utility space. But the moment you open it up for competition, the value of reserves, the value of constrained generation, all those things that we kind of take for granted would definitely increase. And especially if we do have a lot of variable energy generation, ancillary services is growing because there's that backup or the flexibility that the system operator needs. So that would definitely eat into our traditional view of the energy only kind of pricing, that some of the stuff is ancillary services related and therefore the energy component reduces. But definitely capacity, legacy, and subsidy are the three that I think would impact on what is the future energy price. And it may well be that, I mean, energy is going to get cheaper. It definitely is. I mean, we can see it. The renewable energy costs are much, much lower than, say, a new coal plant or whatever. But it's the backup and all the other components of it, which make up the full cost, still have to be recovered in some way. But the energy component will shrink over time, almost definitely.
Thank you.
Okay. And I think that's pretty much it from our side. I know we kind of have used up all the time, but if they're happy, if there are any further questions.
Yeah. So, I mean, I think maybe just one more comment from me. I won't show the slides, is we'll share them after this, is that if you just take the SAP market and you mimic it over the Eskom time of use, and I'm conscious that you said that balancing will be done in a different manner, but you are seeing material differences between standard power and peak power. So it does follow a similar trend, and it does follow the similar time of use approach. So, you know, we shouldn't expect flat tariffs from generators. And you know, 6 o'clock is still really important as opposed to 12 o'clock. Yeah.
Yeah, very much so. I mean, and the idea of the dynamic price is that you see that much more than you would maybe under time of use, which kind of averages things quite a bit. The dynamic price is reacting to the existing environment or the expected environment based on a day ahead market. And you might find that you'll have very high prices in the peak and almost zero prices in the off peak. And we see that internally within Eskom, that, you know, in the winter, when we've got too much on the bars, you know, at 3 o'clock in the morning in the middle of winter, that the prices go to zero. But on the peak, you've got OCGTs running, so that volatility is so very, very high. But again, we don't know. It might be very different in 10 years' time when you've got a different technology makeup.
Thank you. I think we had the 3 questions on this. Oh, here we go. So, so there's one last question here. I don't know if you can see the chat.
Yeah.
And you can maybe just respond to that. I think that's the only other question. And then
yeah, so definitely the Eskom power plants are also, some of them we do see as having a legacy component. And specifically, I'm talking around the capacity charge. When we talk about capacity, obviously, in the future, there could well be a capacity market and capacity is bid in. But the cost for some of our power stations is really high from a capacity perspective. And we might find that that's kind of almost stranded, that you'll never be able to recover that capacity charge in a proper capacity market because battery costs are even cheaper than some of the capacity costs associated with those power stations. So we may decide that, and again, when I say we, I think like regulatory authorities might decide that can be recovered as part of a legacy charge to pay for decisions that were made 10 years ago. And so, yeah, the stranded assets, we use the term stranded assets, but it could well be that there are existing power stations that in the future would not be able to compete in the market, and then that would have to be recovered through a legacy. But a lot of that is around more the fixed costs as opposed to the variable costs of those power stations.
I think that covers my questions, and I don't know if there's any last hands, but otherwise we've reached the end of the hour.
Sorry, one we didn't answer. Sorry, I see here that there was a question about the timeline. So yes, we talk about the transition. Again, it's our perspective of the transition. There is the Electricity Regulation Amendment Bill, which is theoretically going to get to Parliament by the end of this year, if not early next year. We don't know how long Parliament will take to process it. But if passed in the current form, it could well be that in a year and a half, there's a kind of a very clear legal framework for the market, and that it could be in that time frame before we actually start launching our kind of version of the market, in terms of a market code with a vesting contracts to open up the market to more competition. But I can't say for sure. Again, it's a legal process and a parliamentary process before we can finalize on the ERA.
But I understand in the meantime, Keith, you are capacitating yourselves in terms of software team and stuff, so that when that, which is sort of out of your control, can go live, you're ready to go live. Yeah, is that right?
Totally. Yeah.
Thank you very much. That was most helpful, and good luck with your 5 o'clock presentation. But that was
Thank you.
Thank you, everyone, for joining us.
Thanks very much.
Thanks.
Thank you all. Thank you. Cheers. Bye-bye.